Have you ever felt, just completely swamped by all the investment advice out there, the tips, the hot takes, the constant noise?
Absolutely. It's overwhelming.
Yeah, it makes your head spin. And you start wondering, is there a simpler way, a more effective path to building wealth without needing a PhD in finance?
That feeling is so common. The financial world, it often seems like this incredibly complex maze, right? Like only a few experts can really figure it out. And they're always pushing you to do something.
Exactly. Well, today we're diving deep into an investment philosophy that's actually rooted in pure common sense. We'll explore why most investors, probably without even realizing it, turn what should be a winner's game into a loser's game.
And crucially, how you can guarantee you get your fair share of stock market returns.
Right. Our mission here is to unpack the core principles that simplify investing. We want to expose those hidden costs, those illusions that so often derail people's success.
And we're drawing our insights today from, well, an incredibly influential book, a work that's really shaped how millions think about their financial future.
It champions a really straightforward, low-cost approach, something that just cuts through all that Wall Street noise.
Yeah, and it's a message so compelling, even, the titans of finance have had to kind of nod and admit, yeah, there's undeniable truth there.
So whether you're just starting out on your investment journey or maybe you're looking to refine your strategy, this deep dive should give you some clear takeaways, maybe some surprising facts, and hopefully a few aha moments.
The goal is to help you make informed decisions, but without the usual info overload.
Yeah, okay, let's jump in. All right, let's unpack this core idea first. Successful investing at its heart is surprisingly simple. Yet, well, it's not always easy to actually do. What's the fundamental truth we're talking about?
It's interesting. Warren Buffett summed it up brilliantly. He basically observed that the winning strategy is just to own all of the nation's publicly held businesses.
All of them.
All of them. At very low cost. And then, this is key, hold them forever.
Forever.
Pretty much. This approach, he points out, guarantees you capture almost the entire return from dividends and earnings growth. You're essentially owning a piece of the whole economy's productive engine.
Okay, but how do we, as regular investors actually do that? We can't buy shares in every single company.
Right, exactly. And that's where the index fund comes in. It's really an elegant, simple solution.
So what is an index fund, basically?
It's essentially a fund that holds an all-market portfolio. Think of it like a big basket holding, many, many eggs. It's designed to just mimic the overall performance of the entire market, or maybe a big chunk of it, like the S&P 500.
So it's not trying to pick winners and losers?
No, not at all. It's just trying to be the market.
Okay. And what are the real benefits of that? It almost sounds, well, too simple for something as complex seeming as the stock market.
The benefits are actually profound. When you invest in a traditional index fund, you immediately get rid of several layers of risk.
Like,
well, you don't have the risk of picking individual stocks that might just tank. You avoid the risk of focusing on certain market sectors that might suddenly fall out of favor.
okay.
And maybe most importantly, you eliminate manager selection risk. That whole guessing game of trying to figure out which active fund manager is actually going to beat the market this year or next year.
So with an index fund, the only risk left is just the market itself.
Pretty much. The inherent risk of the stock market itself remains. And let's be honest, that's quite large enough on its own.
And how does that translate into results? Because sometimes simple can feel a bit, well, boring in the short run.
Yeah, index funds definitely lack the short-term drama, the excitement of trying to pick the next big thing. But their real power, it's in their long-term productivity. They're built for a lifetime of investing.
Yeah, so.
A traditional index fund is super diversified. It holds pretty much its share of the market's capitalization. An S&P 500 fund, for example, just owns shares of the biggest companies in America in proportion to their size, and then holds them basically forever.
And that leads to?
Minimal expenses, no advisory fees to worry about, tiny portfolio turnover, which is huge, and high tax efficiency. All these things compound positively over time.
Compounding. That brings us to this sort of fundamental tension, doesn't it? You've got the incredible magic of compounding returns on one side.
It's just truly remarkable.
Versus what our source calls the tyranny of compounding costs on the other. Can you walk us through the magic part first?
Sure. The magic of compounding returns is just, wow. Imagine stocks earn, say, 7% a year. Over 50 years compounded, $1 grows to about $30.
$30 from one.
Yeah. It shows how capitalism, through corporate growth and innovation, actually creates wealth. Owning equities long-term has historically been a winner's game. It's a positive-sum game for the owners.
Sounds fantastic. But then there's that tyranny you mentioned. That implies something working against this magic.
Precisely. While capitalism itself is positive-sum, the financial system built around it, that often turns it into a very different game for us, the individual investors.
How so?
Well, studies suggest that the typical investor in individual stocks has probably lagged the market return by about 2 percentage points a year.
2% a year. That adds up.
It really does. Now, before you deduct any investing costs, beating the market is a zero-sum game. For every winner, there has to be a loser. Your gain is my loss, essentially.
Okay, zero sum before costs. What happens after costs?
That's where it flips, becomes a loser's game. After you deduct all the costs, the fees, commissions, trading expenses, the financial intermediaries, the sort of croupiers running the investment casino, they always win.
They get their cut regardless.
Exactly. So investors, as a group, always lose after costs. Successful investing, then, is really about minimizing Wall Street's share of the pie and maximizing your share, Main Street's share.
And how do you do that?
By minimizing trading. Study after study shows that active traders dramatically underperform precisely because of these compounding costs.
So the solution is really about cutting trading, cutting costs to guarantee you get your fair share. It seems like such a powerful, almost undeniable idea.
It is. Mathematically, it's irrefutable, but, it often feels counterintuitive. We're drawn to the excitement, right? Buying and selling, finding the next big thing.
The thrill of the chase.
Yeah, that engagement, however costly it is, plus just a general lack of awareness about how much these costs really hurt. It makes this simple philosophy hard to stick with.
But it's validated by experts.
Oh, yeah. Nobel laureate Paul Samuelson said these kinds of reasoned ideas can help savers sleep well, securing their future just by looking after their own basic self-interest.
That's powerful. Now, let's pivot to that story, the parable adapted from Buffett about the Gottschalk family. It really clarifies this whole conflict, this idea of helpers and their hidden costs.
It's a classic, really illustrates the dynamics perfectly, how wealth grows and what erodes it.
Okay, so the story goes. There was this wealthy family, the Gottschalks, thousands of members, and they owned 100% of every stock in the U.S.
Imagine that.
Right. Each year, they got all the earnings growth, all the dividends from all those companies. Their wealth just compounded beautifully. Huge prosperity. The Gottschalks were playing a winner's game. Sounds ideal.
Absolutely. Capturing the full benefit of capitalism.
It was ideal for a while, but then you know how families are. Some Gottschalks members decided they were smarter than the others.
Uh-oh.
Yeah. They started trying to outsmart their relatives. They hired helpers, brokers, money managers, consultants. And these helpers, naturally, charged fees for their services.
And that's where the trouble starts, like Buffett said.
Yeah.
When trillions are managed by Wall Streeters charging high fees, it's usually the managers, not the clients, who make the outsized profits.
Exactly. So over time, the family's 100% share of the pie, all those dividends and earnings, it started to shrink significantly, down to just 60%.
Yeah, 40% gone.
Yeah. They finally asked, wait, how did our 100% share dwindle to 60? And the wisest member, the sage old uncle, softly said, all that money you paid the helpers, all those extra taxes, it comes directly out of our family's total earnings. Go back to square one, get rid of the brokers, the managers, the consultants. Then our family will again get 100% of whatever pie corporate America bakes for us.
Wise words.
They followed his advice, went back to their original passive productive strategy, just holding all the stocks, standing pat. And that fundamentally is what an index fund does.
The moral is crystal clear. Don't do something. Just stand there. More activity means more costs, more taxes, lower net returns. Index funds embody that passive productive approach.
So the parable really highlights that deep conflict of interest, doesn't it? Wall Street wants you to do something because that makes them money.
Right, activity generates fees.
But our financial interest as investors is often the exact opposite. Don't do something, just stand there.
Precisely. Jack Meyer, who ran the Harvard Endowment, called the investment business a giant scam, confirming most managers fail to beat benchmarks because of fees. David Swenson at Yale, The Economist, they all echo this. The index fund aligns your interest with the market's return, not the industry's profit.
This brings us to a really critical point about how stock market returns actually break down. This is where it gets super interesting, I think. We see the daily ups and downs, the headlines, but what really drives long-term returns?
Again, let's go back to Buffett. He said, the most that owners in aggregate can earn between now and Judgment Day is what their businesses in aggregate earn.
Okay, so shareholder gains have to match business gains over time.
Exactly. The fundamental truth, but it often gets lost in all the market noise.
So it's about the underlying businesses. How does that translate into the actual components of our stock market returns? What makes up that final number?
Stock returns basically have two parts. First, there's the investment return, sometimes called enterprise return. This is the real value generated by the businesses themselves.
Yeah.
It's the initial dividend yield plus the earnings growth that follows. Historically, since 1900, this has averaged about 9.0% a year. That's the real productive engine.
Got it. Investment return. What's the second component?
That's the speculative return. This is purely the effect of changing price-to-earnings multiples, the PE ratios.
Ah, the market sentiment part.
Exactly. It reflects investor emotions, greed, hope, fear. When PE ratios go up, it boosts returns. When they fall, it drags returns down. This part explains the gap between the pure business gains and the total market return you actually see.
I see. So investment return is a steady engine. Speculative return is like the emotional gas pedal or brake. How do these two play out over the really long term?
Well, historically, while you can get big short-term differences between them, these divergences tend to be, well, short-lived. Over a century plus, $1 invested in 1900 grew to an amazing $43,650 by 2015. Annual returns are volatile, sure, but that volatility comes mostly from those investor emotions swinging the PE ratios around, not usually from big changes in the underlying business economics.
That's a crucial difference. It reminds me of what Keynes warned about, applying past experience blindly.
Right. Keynes cautioned against using past data unless you understand why things happened the way they did. This helps us separate the lasting economics from the temporary speculation. Over the very long term, like a century, that speculative return part, it often adds very little, maybe only half a percentage point per year to the total return.
So the big takeaway is that long term, the real economy is what drives returns.
Exactly. That long-term average total return was around 9.5%. Almost all of it, 9.0%, came from the enterprise, the businesses. Only a tiny bit, 0.5%, came from speculation.
So investor perception just kind of dissolves over time.
Pretty much. Economics controls long-term returns, not short-term feelings.
Roger Martin's distinction between the real market and the expectations market helps visualize this, I think.
It really does. The real market is where companies actually make things, sell things, earn profits, pay dividends. That takes strategy, innovation. That's investing.
And the expectations market.
That's where prices are set by what investors expect other investors will expect. It's all about guessing games. That's speculation.
So what does this all mean for us, the everyday investor? It sounds like the stock market itself can sometimes be a giant distraction to the business of investing.
That really raises the key question, doesn't it? How do we focus on the productive long-term economics of the businesses we own and just ignore all the sound and fury of short-term market emotions?
Then the answer is?
The answer is to cast your lot with the real market of business, not the fickle expectations market.
And this isn't exactly a new idea, right? Benjamin Graham, Buffett's mentor, had to take on this ages ago.
He certainly did. Graham's timeless distinction. In the short run, the stock market is a voting machine. But in the long run, it is a weighing machine.
Voting versus weighing.
Exactly. His Mr. Market idea illustrates it perfectly. Imagine you co-own a business with Mr. Market, who shows up daily offering to buy your share or sell you his. Sometimes his price makes sense. Sometimes it's just silly.
Okay.
Graham said a smart investor ignores Mr. Market's daily moods. Instead, they forget about the stock market and pay attention to his dividend returns and to the operating results of his companies. Focus on the real value, the business performance.
Okay, so we've established that owning businesses long-term, focusing on the real economics, not speculation, that's fundamentally a winner's game. But then why do most investors seem to fail so badly at capturing those returns? There feels like a massive disconnect there.
You've absolutely nailed the core problem. It boils down to what our source calls the relentless rules of humble arithmetic, specifically unavoidable costs.
Costs again.
Always costs.
Yeah.
Remember, before costs, beating the market is zero-sum. One person's gain is another's loss, but after costs, it inevitably becomes a loser's game. Your net return has to be lower than the market's gross return by exactly the amount of those costs. It's just simple math.
So those costs are the tyranny we talked about earlier. Can you break down what these all-in costs actually include for a typical investor?
Sure. If you're trading individual stocks yourself, trading costs can average, say, 1.5% or more per year. If you're using actively managed equity mutual funds, there are layers.
Okay, layer one.
First, the expense ratio. That's management fees, operating expenses. Averages may be 1.3% a year.
Layer two.
Sales charges or loads. These upfront or back-end fees can add another 0.5% to 1.0% per year if you spread them over, say, a 5 or 10-year holding period. Though many funds are no load now, loads definitely still exist.
And what about the less obvious sort of hidden costs?
Ah, yes, the insidious hidden turnover costs.
Yeah.
These are often invisible, but very real, my estimate. They average a full 1% per year.
How does that work?
Think about it. An active fund might have 80% portfolio turnover. That means it's buying and selling a huge chunk of its holdings every year. That generates brokerage commissions, bid-ask spreads, market impact costs, all paid by you, the shareholder.
Wow. So add it all up.
The all-in costs for active funds, easily 2–3% per year.
That is a huge bite out of returns. It seems almost ironic.
It's the grim irony, isn't it? As investors, we not only don't get what we pay for because we pay for active management that, in aggregate, can't beat the market after costs, but we get precisely what we don't pay for.
Meaning,
if we pay nothing in these excess costs, we get everything the market's gross return. It's just common sense, really.
And Justice Brandeis seemed to get this nearly a century ago, writing about financial intermediaries.
He did. Brandeis saw they were obsessed with the delusion that investors get 100% of the market return. Upton Sinclair's famous paraphrase nails why this delusion persists. It's amazing how difficult it is for a man to understand something if he's paid a small fortune not to understand it.
True. The system profits from complexity and activity.
Exactly. Its self-interest doesn't exactly encourage investors to see the obvious cost drag.
Okay, let's really hammer this home with an example, because the tyranny of compounding costs is, well, devastating. Let's imagine that 7% annual market return versus a 5% net return for an average fund because of 2% costs over 50 years. What's the damage?
The damage is staggering. Okay, $10,000 invested in the market at 7% grows to nearly $295,000 over 50 years.
Okay, impressive.
But in that average active fund, losing 2% to costs each year, that same $10,000 grows to only about $115,000.
Wow, that's a shortfall of over $180,000.
Exactly. Those costs eat up more than 60% of your potential gains over half a century. You end up with less than 40% of the return, even though you took 100% of the risk. It's harsh. In the investment field, time doesn't heal all wounds, it makes them worse. Time helps returns compound, but it helps costs compound too, working against you.
This means the humble arithmetic, the inevitable penalty of costs, has just decimated mutual fund investor returns. It's almost unbelievable how much wealth just evaporates.
Which brings us to the crucial question. What can investors do to avoid this devastation? Low-cost index funds offer that guaranteed path. You earn your fair share of the market's returns simply by eliminating the vast majority of these erosive costs. Peter Lynch, the legendary manager, even admitted when he retired, the public would be better off in an index fund.
Even high-profile figures concede the point.
Yeah, James Cramer of CNBC admitted Bogle's arguments had him thinking of joining him. The evidence is just overwhelming.
Okay, if costs are so devastating, then finding the lowest cost options has got to be paramount. Is it really as simple as just picking the cheapest fund available?
In essence. Yeah, it often is that simple. Think about it. Fund performance comes and goes, right?
Yeah.
It's fleeting. But costs, they endure.
They stick around.
They stick around. The single most powerful factor for selecting winning funds, shown again and again historically, is focusing on costs, not past performance. High-cost funds tend to stay high-cost. Low-cost funds tend to stay low-cost. That persistence makes cost a reliable predictor, unlike performance.
So just to recap those costs and how they persist.
Right. Three main types. First, the expense ratio. Most visible cost. High ones, over 2% maybe, stay high. Low ones, under 0.5%, stay low. Second, sales charges or loads. Also persistent. Load funds rarely become no load.
And the third, the hidden ones.
Yeah, the portfolio turnover costs, the transaction costs from buying and selling. Active funds average nearly 80% turnover a year. That costs you estimated around 0.8% annually just from turnover.
That's a lot of money quietly vanishing. But when you combine these, especially the hidden ones, with actual returns, does the picture really become, as our sources say, sheer dynamite?
Oh, absolutely. Look at the analysis over decades. Combining expense ratios and turnover costs, the all-in costs range from just under 1% for the lowest cost funds to over 2% for the highest.
Okay.
Now, here's the dynamite part. The resulting net annual return, over 9% for the lowest cost funds versus just over 8% for the highest cost. That's more than a 1% annual advantage just from minimizing costs.
So the gross returns before any costs were basically the same for all these different cost groups.
Precisely. The gross returns were virtually identical across the board. It's compelling proof. Costs, and costs alone, explained essentially all the differences in net returns. And get this, the lowest cost funds also carried significantly less risk.
Less risk and higher return.
Exactly. Their risk-adjusted return was noticeably higher.
And over a long investment horizon, say 25 years, those small differences must compound into something massive.
They certainly do. That annual advantage compounded over 25 years. It led to a cumulative return for the lowest cost funds that was over 35% higher than for the highest cost ones. It just definitively shows that fishing in the low-cost pond pays off big time.
And Morningstar, the big independent research firm, they confirm this too, right?
Absolutely. Morningstar's flat out stated if there's anything in the whole world of mutual funds that you can take to the bank, it's that expense ratios help you make a better decision. In every single time period and data point tested, low-cost funds beat high-cost funds.
That's pretty definitive.
It's not opinion. It's empirical fact. The ultimate truth is just simple. The more the managers and brokers take, the less the investors make. Again, if the managers and brokers take nothing, the investors receive everything, meaning the total return of the market.
This is such a powerful message, and it's not just us saying it. Tyler Matheson at CNBC, who apparently initially dismissed these ideas, had a very public change of heart.
Yeah, his words are quite a testament. Matheson conceded the superiority of low-cost, low-turnover, tax-efficient index funds. He said, "Jack, we were wrong. You win." He praised their low expenses, low turnover, tax efficiency, and concluded indexing should form the core of most investors' fund portfolios. Can't get much stronger validation than that.
Okay, let's talk dividends. They often seem like, I don't know, a minor detail to a lot of investors, sort of lost in the excitement of capital gains. But this deep dive really shows they play a surprisingly massive role in long-term wealth.
Oh, they are absolutely vital, not minor at all. Since 1926, dividends have kicked in an average annual return of 4.2%. Now get this. That accounts for fully 42% of the stock market's total annual return over that long period.
42%. Wow, that's nearly half the market's historical return just from dividends.
Exactly. Not a minor detail.
Can you put that into perspective, like with a real-world example?
Sure. The power of reinvested dividends is just astonishing. Imagine you put $10,000 into the S&P 500 back in 1926.
Okay.
If you only track the price increase, no dividends reinvested, that $10 would have grown to about $1.7 million by 2017. Still pretty good.
Yeah, not bad.
But if you had reinvested those dividends along the way, that same $10,000 would have mushroomed to some $59.1 million.
$59 million versus $1.7 million? That's insane.
It's a $57.4 million gap. It just shows the magic of cost-free compounding that dividends offer when you put them back to work.
And are dividends a stable source of return, or do they jump around wildly like stock prices can?
Remarkably stable, actually. The annual dividends per share of the S&P 500. Over 90 years, there have only been 3 major drops. Even through the Great Depression, the 2008 crisis, they held up incredibly well.
They bounced back.
And bounced back to new highs after 2008. They provide a really consistent and growing income stream over the long haul.
Okay, given this huge, stable power of dividends, you'd think active managers would prioritize them, right? Or at least let investors fully benefit. But here's where it gets really interesting. It turns out many active funds actually confiscate a huge chunk of this dividend income. How does that happen?
Yeah, this confiscation happens because mutual fund contracts almost always base advisory fees on the fund's total assets, not on its dividend income.
Okay.
So when stock dividend yields are low, like they have been sometimes, fund expenses end up eating a huge share of the total dividend income the fund actually earns. The result is truly staggering.
Staggering how? What are the numbers?
Okay, look at actively managed growth funds. Expenses can consume basically 100% of the fund's dividend income.
100%.
Yep. For actively managed value funds, it's still incredibly high expenses consume about 58% of dividend income.
Wow.
Now, compare that to low-cost index funds, a growth index fund. Expenses ate just 4% of dividends. A value index fund, only 2%.
That's an enormous difference. active funds are basically stripping away most or all of your dividend benefit.
Pretty much.
That's incredible. How are investors not more aware of this astonishing confiscation, as the book calls it? Seems like it should be headline news.
Well, it's often buried, it's hidden in plain sight. You could maybe figure it out from a fund's complex financial statements, but let's be honest, those things aren't exactly models of clarity for the average person.
Yeah, they're dense.
Exactly. That complexity lets the practice continue largely unnoticed.
So the index fund, again, offers a really straightforward advantage here.
Absolutely. A low-cost index fund, no active manager to pay huge fees to. Minimal expense ratio, like 0.04% in some cases. You get your fair share of the dividend income. Plus, almost no trading, so no hidden transaction costs eating away at things.
Makes sense.
As one blogger put it, dividends have that smooth uptrend, great for dependable income. Keeping it simple means owning stocks and bonds at low cost. Let the dividends flow.
Okay, even when active funds report returns that maybe seem, just inadequate compared to index funds, our source says there's a deeper, more generous illusion going on. What's this hidden layer that disconnects investors even further from their potential gains?
Right. This is a critical point that so many people miss entirely. Fund managers usually report time-weighted returns. That just reflects how the value of each share in the fund changed over time.
Okay, the fund's performance.
Right. But that fund return, it doesn't tell us what the average fund investor actually earned, because investors move money in and out of funds. The investor return, called the dollar-weighted return, accounts for those cash flows. And it turns out to be considerably worse.
Considerably worse. So what's the shocking lag here? What's the real number for the average Joe investor?
Okay, let's look at the period 1991 to 2016. The S&P 500 index returned 9.1% a year. The average equity fund earned 7.8%.
Still lagging, but okay.
But the average fund investor, they only earned 6.3% a year.
Only 6.3%. That means the average investor earned 1.5 percentage points less than the average fund itself, and almost 3 points less than a simple index fund.
Exactly. A staggering 2.8 percentage points less than the S&P 500.
So what does this all mean? The average investor is getting significantly less than even the mediocre returns the funds report. How does this massive gap happen?
It's a nasty combination of two penalties, costs, which we've talked about, and crucially, investor behavior.
Bad decisions, basically.
Pretty much. First, faulty timing. Investors tend to pour money into funds after they've had good performance, often near market peaks.
Buying high.
And then they pull money out after bad performance, often near market bottoms.
Selling low. Classic mistake.
Devastating. Second, adverse fund selection. Investors chase the hot funds, whatever tech or growth fund did great last year, only to see performance revert to the mean and the fund tumble.
Can you give us a concrete example of the compound impact of this? Let's say someone started it with $10,000.
Okay, $10,000 invested back in 1991. An S&P 500 index fund would have generated about $77,000 in profit by 2016.
Nice.
The average equity fund would have yielded $55,500 profit. Still okay?
But the average investor?
The average fund investor, because of those timing and selection errors, their profit would have tumbled to just $36,100.
Less than half of what the index fund delivered.
Less than half. And after you account for inflation, the index fund's real return was 6.2% a year. The average fund investor's real return, a pitiful 3.6%. It's just hard to imagine such a staggering gap.
So it's really our own emotions, combined with the way the fund industry promotes itself, that creates this perfect storm for underperformance.
That's exactly right. The industry often makes it worse, right? Creating new economy funds, heavily advertising those flashy past returns, feeding our appetite for speculation. It fuels that counterproductive behavior.
So the index fund is the solution again.
It offers a compelling solution here. It eliminates the temptation to make those bad choices. It takes emotions out of the equation, mostly. By just holding a broad market index fund through thick and thin for an investment lifetime, you stay the course. The winning formula is owning the whole market via an index fund and then doing nothing. Just stay the course.
And this powerful insight has some serious backing. Warren Buffett talks about the enemies of the investor.
He does. His famous 4 E's, the greatest enemies of the equity investor are expenses and emotions.
Expense and emotion.
Even Charles Schwab, who runs a giant brokerage, invests most of his own money in index funds. He asks, why would you screw it up?
Good question.
And Mark Holbert confirms the paradox. Gunning for average is your best shot at finishing above average. The evidence is clear. Fighting your own nature and the market's siren song is incredibly tough. The passive index approach is the most reliable path to getting your fair share.
Okay, just when you thought we'd covered all the costs, management fees, loads, hidden turnover, there's another major one lurking. Often ignored. Slashing your net returns even further. The silent killer. Taxes.
That's right. Federal, state, local income taxes. And the reality is, most actively managed mutual funds are, frankly, astonishingly tax inefficient.
Why? What makes them so bad with taxes?
It goes back to that high turnover. The frenetic traders they employ, their short-term focus. It generates substantial capital gains, realized gains, which are then passed through to you, the investor, to pay taxes on.
So their constant trading is basically a tax-generating machine.
Precisely. That average active equity fund turnover of 78%. It means the average stock is held for just 19 months. All that buying and selling creates taxable events.
And the index fund?
The traditional index fund follows a buy and hold forever policy. Annual turnover is tiny, maybe around 3%.
Yeah.
Result, infinitesimal transaction costs and far, far fewer realized capital gains to worry about.
Can you walk us through the after-tax impact? Because the numbers must be pretty stark here, too.
They are. Let's use that 1991-2016 timeframe again. Average equity fund. 7.8% pre-tax return. High turnover leads to an estimated annual federal tax burden of maybe 1.2 percentage points. That cuts the after-tax return down to 6.6%.
Okay. And the index fund?
Index fund. 9.0% pre-tax return. Lower taxes because of fewer capital gains, mostly just tax on the dividend income.
Yeah.
After-tax return, 8.6%, maybe losing only 0.45% of taxes.
That's a 2 percentage point difference after tax each year. So for that $10,000 initial investment.
Right. The active fund generated about $39,700 in profit after tax. The index fund, $68,300 after tax.
Wow. The active investor lost out on almost $30,000 just due to the tax inefficiency on top of the higher fees.
Exactly. It's a clear illustration. Fund returns get devastated by costs, bad investor behavior, and taxes. It's a triple threat.
Now, there's an interesting sort of paradox about index fund tax efficiency you mentioned regarding dividends.
Yes, it's a nuance worth understanding. Index funds are great at minimizing capital gains taxes because they don't trade much. But because their costs are rock bottom, almost all the dividends paid by the stocks they hold flow straight through to shareholders.
Which sounds good.
It is good.
Yeah.
But it means index fund investors often receive more taxable dividend income compared to investors in high-cost active funds, because those active funds consume a bigger chunk of the dividends with their expenses before they even reach the investor.
I see. So you get more of your fair share with the index fund, but that share is then subject to dividend tax.
Exactly.
So what's the bottom line here? It just reinforces the idea that returns get hammered by costs, behavior, and taxes. A multi-pronged attack on your wealth building.
Indeed. Experts like Chauvin and Dixon highlighted how funds failed to defer taxes effectively. William Bernstein stated it's truly a terrible idea to own active funds in taxable accounts because taxes can be such a drag. He concludes, for the taxable investor, indexing means never having to say you're sorry. Minimizing those capital gains distributions is a huge advantage for taxable accounts.
Looking ahead, can we realistically expect the kind of amazing returns in stocks and bonds that we've seen, say, over the last few decades? It feels like maybe the conditions that drove those returns aren't really here anymore. Is the answer likely no?
That's a really crucial point for investors today. The principle we discussed holds. Business reality dividends plus earnings growth drives long-run returns. But recent decades got an unusual boost from speculative return.
The PE ratio is expanding.
Exactly. The price-earnings multiple more than tripled from the mid-70s to early 2017. Historically, that speculative part only added about 0.5% per year. So it's just unrealistic to expect that kind of PE expansion to keep boosting future returns. Both common sense and humble arithmetic point towards, well, more subdued returns ahead compared to the long historical average.
Okay, let's break down the arithmetic behind this caution. Looking at the sources of stock returns, what are the key parts of a projected future investment return?
Right. First, the current dividend yield on stocks is only around 2.0%. That's way lower than the historical average of over 4%. That's a drag right there.
Okay, lower starting yield.
Second, future corporate earnings growth. It's probably going to be around 4 or 5% a year, roughly tracking nominal GDP growth.
Yeah.
Again, maybe a bit lower than historical averages. Combine those two.
2% yield plus 4% growth.
You get a likely annual investment return around 6%.
Okay, 6% from the business reality. What about that speculative part, the PE changes?
Well, as of early 2017, when the source was written, the S&P 500's PE was quite high, historically speaking. If it just moderates back towards a more normal level over the next decade, that could easily subtract about 2 percentage points per year from returns.
So 6% investment return minus 2% speculative drag.
Leads to a cautious projection for the total stock return, around 4% annually.
4% nominal, that's quite a bit lower than history, but you encourage listeners to do it yourself if they
Yeah,
disagree.
absolutely. Take the current dividend yield. Plug in your own rational expectation for earnings growth. Add your own view on where the PE ratio will be in 10 years. That gives you your reasonable expectation for future stock returns.
Now, figuring out future bond returns seems even simpler. What's the main driver there?
For bonds, it's overwhelmingly one thing: the prevailing interest rate, the initial yield when you buy them. Historically, that initial yield explains like 95% of the returns you get over the next decade.
So what's the current yield suggesting?
Well, at the time of the source, the yield on a broad bond market portfolio was around 3.1%. So that's our best guess for future annual bond returns, about 3.1%.
Okay, so if stocks are maybe around 4% and bonds around 3.1%, what does that mean for a typical balanced portfolio, like a 60-40 mix?
For a 60-40 portfolio, the projected nominal return is about 3.6% a year. But here's where costs become absolutely critical.
Right, in a low return world.
Exactly. If you assume average active funds cost at least 1.5% a year, and you factor in maybe 2% inflation, the real annual return for that typical balanced portfolio, it drops to a mere 0.1%, basically zero, after costs and inflation.
Wow. It might seem absurd to project near zero real returns for typical balanced funds.
It does sound absurd. But you connect it back to the big picture. The relentless math of excessive costs gets magnified hugely in a low-return world. Think about it. 2% cost plus 2% inflation eats up 100% of a 4% nominal stock return. Unless the fund industry dramatically cuts costs, high-cost active funds look like a uniquely bad choice going forward.
This means investors absolutely must focus on optimizing their strategy. Our source lists 5 options for improving returns, but says only 2 are really high probability winners.
That's right. The 5 options include selecting very low-cost index funds or selecting active funds with rock-bottom costs, low turnover, and no loads. The other 3 involve trying to pick winning funds based on past performance or getting advice to do so.
And only the first 2 are reliable.
Only the first 2, focusing relentlessly on cost, offer a high probability of success. As experts have noted, the aggregate alpha or outperformance is 0 or negative after costs, and high fees just sap performance. The message is unavoidable. Costs are the enemy, especially when future returns are likely to be lower than we're used to.
We are constantly bombarded, aren't we, by the financial media telling us to look for star managers or funds with superior records. But does that approach actually work over the really long haul? Is finding that supposed needle in the haystack a viable strategy?
It's definitely an attractive idea, the hero manager, but unfortunately, there's just very little evidence that past performance persists into the future. It's easy to see who was a winner. Predicting who will be a winner, much, much harder.
It's hard.
Consider this. Of 355 equity funds that existed back in 1970, an astonishing 281 of them, almost 80% were gone by 2016, merged, liquidated, disappeared.
80% failure rate. That's incredible. If your fund doesn't even survive for the long term, how can you possibly invest for the long term in it?
Exactly. And you can bet it wasn't the best performers that went to their well-earned demise. Funds vanish for lots of reasons. Managers leave, companies get bought, investors flee poor performers, making them too small to run profitably.
What about the really famous star funds like Fidelity Magellan or Fidelity Contrafund? They had legendary managers, legendary runs. Do their stories offer a different lesson? Maybe size matters.
Their stories are fascinating precisely because they illustrate the challenges of size and, eventually, that reversion to the mean principle. Magellan, under Peter Lynch. Astonishing outperformance early on when it was small.
Right, legendary.
But as assets ballooned into the tens of billions, that outperformance shrank and eventually even underperformed the S&P 500. Buffett's line, "A fat wallet is the enemy of superior returns," really hits home. Contrafund showed a similar pattern.
So size makes it harder to keep winning.
Immensely harder. And these stories also highlight how investors often shoot themselves in the foot, pouring money in when funds are hot and pulling it out when they cool off. Classic counterproductive behavior.
So what does this all mean for us? The odds of picking a winning fund, even one with a great long-term record, seem incredibly low, almost insurmountable, really.
They are, frankly. It's truly like looking for a needle in the haystack. And the source offers a great corollary. Don't look for the needle in the haystack, just buy the haystack.
Buy the haystack, meaning
The entire stock market portfolio, readily available through a low-cost index fund. That simple index fund would have matched or beaten 345 out of those 355 funds in that 46-year contest we mentioned.
Wow. So when we think about our investment lifetime, it really boils down to two basic options.
Essentially, yes. Option 1, try to pick active funds. Know their managers will change, the funds might disappear. You'll likely own dozens of funds over your life, each dragging fees and turnover costs.
Or option 2.
Option 2, invest in one low-fee, low-turnover, broad market index fund for life. You get the certainty of tracking the market. Simplicity, cost efficiency, staying the course. That should win. It's what Buffett directed for his wife's trust, 90% in a low-cost S&P 500 index fund. He decided to buy the haystack.
Okay, let's talk about those star ratings and top performers the financial world constantly throws at us. Funds get marketed with these 5-star ratings, implying that yesterday's winner is likely to be tomorrow's winner. But does past performance actually mean anything for future returns?
The answer is a resounding, emphatic no. And the reason is that powerful, pervasive principle, reversion to the mean, RTM, those star ratings. They're heavily biased towards recent performance, creating an illusion of persistent skill.
An illusion? How so?
Well, one study showed only 14% of 5-star funds from 2004 still had that rating a decade later. Half dropped to 3 stars or less. That's RTM biting hard. Top performers tend to drift back towards average or even below average over time.
So the data really backs this up.
Overwhelmingly. Look at funds over consecutive 5-year periods. Only about 13–15% of the top-performing funds in one period stayed in the top group in the next 5 years.
Only 13–15%. That's barely better than chance.
Exactly. And get this, a remarkable 20–27% of those previous winners actually fell all the way to the bottom quintile in the next period.
Wow, from top to bottom. These data are truly amazing. They just completely undermine the idea that manager skill persists. It looks almost random.
It reveals remarkably little persistence in returns. We are, as Nassim Taleb famously put it, fooled by randomness. And conversely, a good chunk of the worst performers from the first period actually ended up near the top in the next period.
So RTM works both ways.
It does. These studies clearly show RTM as a powerful force. There's just no reliable way to predict future winners based on past success.
So the message is crystal clear. Chasing past winners is just a fool's errand. Don't do it.
Precisely. As the book says, the stars produced in the mutual fund field rarely remain stars. All too often they are meteors. They burn bright for a moment, then fade.
Why is this so hard for us to accept?
Nobel laureate Daniel Kahneman explained it well. Our minds are strongly biased toward causal explanations. We want a reason why someone succeeded. RTM has an explanation, the statistical tendency for extremes to regress, but it doesn't have a simple cause we can point to. We prefer stories over statistics.
And this principle is backed by so many experts.
Absolutely. Taleb's coin toss example shows how pure luck can create amazing track records. Jason Zweig at the Wall Street Journal says buying funds based on past performance is one of the stupidest things an investor can do. That warning on every prospectus, past performance is no guarantee of future results. It's not just legal jargon, it's the math.
Okay, with all this complexity, the overwhelming evidence against picking active funds, it's understandable why many of us seek professional advice. But how much value do advisors really add, specifically when it comes to selecting funds for us? Is getting a helper for fund selection a good idea?
Well, advisors can provide really valuable services. Let's be clear about that. They can help with asset allocation, tax planning, saving strategies, spending advice, and critically behavioral coaching.
Helping us avoid those dumb mistakes.
Exactly. Like chasing performance or panicking in a downturn, those peripheral services can definitely enhance your overall financial plan.
But specifically on selecting active funds, is the evidence positive there? Are these helpers adding value or subtracting value in that area?
The evidence on active fund selection by advisors is, well, pretty skeptical. As a group, advisors are likely average selectors before you even factor in their fees.
Okay.
Now, they can help if they choose low-cost, low-turnover, tax-efficient index funds, and thankfully many increasingly do. But studies show their advice on picking active funds hasn't, as a group, led to better-than-average returns for clients. One study found broker-sold funds underperformed direct-sold funds, costing investors billions a year.
Billions a year. That's a huge gap. And we've seen some truly awful examples like that Merrill Lynch case around the tech bubble.
A shocking example.
Mm-hmm.
March 2000, peak of the bubble.
Yeah.
Merrill brokers sold $2 billion of new Focus 20 and Internet Strategies funds.
Oh.
The Internet Fund lost 86% in 18 months and was shut down. The Focus 20 fund lost 79% over 6 years. It was a marketing success for Merrill Lynch, an investment disaster for its clients. It just highlights the massive conflict of interest when brokers get paid to push new, often hyped products.
It's no wonder, then, that alternatives like robo-advisors have popped up.
Exactly. Computerized advice, often recommending diversified, buy-and-hold index fund portfolios, usually using ETFs, it cuts out some of that conflict.
So if you are choosing a human advisor, what should you look for?
2 crucial things. First, make sure they operate under a fiduciary standard. That means they are legally required to put your interests first. Registered investment advisors, RIAs, have this standard.
Okay, fiduciary standard. What else?
Be acutely aware of their fees. They typically start around 1% of your assets and might scale down. Compare that cost to the value of the services you're getting. And, not surprisingly, favor advisors who recommend low-cost stock and bond index funds in their model portfolios.
So the core message is, be incredibly careful when seeking advice, especially about active fund selection. Know the potential conflicts.
Absolutely. William Bernstein advises ensuring your advisor chooses investments purely on merit, not based on how they get paid. He strongly recommends fee-only advisors and says your advisor should use index passive stock funds wherever possible. Protect yourself from conflicts and unnecessary costs.
Okay, having navigated all the pitfalls, the hidden costs, the illusions of active management, it's time to really talk about the triumphant alternative. The majesty of simplicity. What does this majesty actually look like in practice?
It's really the logical endpoint of everything we've discussed.
Yeah.
We've learned costs matter hugely. Past performance doesn't predict future results. Reversion to the mean is real. Advice on fund selection is spotty at best.
Right.
So, given that low costs are demonstrably good, the simple logical conclusion is to focus on the lowest cost funds of all. Traditional index funds, ETFs that own the entire market.
And the costs on these TIFs are incredibly low, aren't they? We're talking fractions of a percent.
Tiny. Some of the biggest TIFs have annual expense ratios as low as 0.04%, 4 basis points. Their turnover costs are near zero, so their all-in costs are minimal, way, way below even the cheapest quartile of active funds.
Yeah.
This real-world superiority of a broad market index fund versus the average active fund over decades, it's compelling. It's unarguable.
And what do statistical models say about the probabilities going forward? You mentioned a Monte Carlo simulation.
Right. These simulations project the odds. And even if you're generous to active funds, the results are stark. Over 50 years, maybe only 2%, a tiny fraction of active managers would even be expected to outperform a low-cost index fund. This arithmetic, I really believe, demands that index funds hold an important place in your portfolio.
It really highlights that phrase. The majesty of simplicity in an empire of parsimony. Frugality wins.
Indeed. And these conclusions aren't based on opinion. They rely largely on mathematical facts, those relentless rules of humble arithmetic. Ignore them at your peril. They are the foundation of truly informed investing.
Are all index funds created equal? Even within the index fund world, are there cost differences that actually matter?
That's an excellent question, and a crucial caveat. No, all index funds are not created equal. While their underlying portfolios might be very similar, tracking the same index, their costs can vary widely. Some offer those minuscule expense ratios, no loads. Fantastic. Others, however, can have significantly higher expense ratios plus upfront sales loads. Even small cost differences add up over time. That 0.04% fund versus even a 0.25% fund. Over 25 years, that small difference can mean thousands of dollars less in your pocket from the slightly higher cost fund.
So even when choosing an index fund, you still need to be vigilant about costs.
Absolutely. As the source puts it, your index fund should not be your manager's cash cow. It should be your own cash cow. Stick with the lowest cost, no-load index funds from reputable firms.
And does this indexing principle work everywhere, like large cap stocks versus small cap? What about international markets? Does it hold up?
Yes, indexing works everywhere it's been tried. Whether you think markets are efficient or inefficient, the fundamental truth remains. All investors as a group in that segment earn the return of that segment.
So active managers can't beat the average in aggregate, even in supposedly less efficient markets.
Exactly. While some active managers might get lucky or be skillful and achieve big returns, especially in less efficient markets, that just means others must have suffered unusually large losses. In aggregate, they are the average, minus costs. Reports consistently show international indexes outpacing most active international funds, emerging markets too.
It seems like trying to bet on winning sectors or chasing hot areas is still a dangerous game, even if you use index funds to do it.
It is. While you can efficiently invest in specific sectors using index funds, betting on one sector over another, that's just gambling, which is usually a loser's game. Why? Because investor emotions almost certainly get in the way, leading to performance chasing. The mathematical certainty of owning the whole market at rock-bottom cost remains the gold standard. Charlie Munger, Buffett's partner, nailed it. The wiser choice is to dispense with the consultants and reduce the investment turnover by changing to indexed investment. Simple.
Okay, the focus is often heavily on stocks, and for good reason. But what about the fixed income side of our portfolios? Bonds. Do these relentless rules of humble arithmetic apply there too? Or is bond investing somehow different?
They apply, arguably, even more forcefully to bond funds.
More forcefully, why?
Because while the stock market has countless influencing factors, bond returns are largely dominated by just one thing: the prevailing level of interest rates. Bond fund managers simply can't do much to influence interest rates, so their ability to add alpha or outperformance is severely limited from the start.
So why would an intelligent investor hold bonds at all, especially if stocks generally offer higher returns over the very long run?
Several really good reasons. First, the long run is made up of many short runs, and bonds have actually beaten stocks in many years, even some 5- and 15-year periods.
Okay, so short-term outperformance is possible.
Second, and maybe most importantly, volatility reduction. Bonds provide downside protection during big market drops. They act as an anchor to windward. This helps reduce that counterproductive behavior, like panicking and selling stocks at the bottom.
Right, the emotional buffer.
Exactly. And third, bonds offer a steady income stream, which can be very valuable, especially as yields fluctuate relative to stock dividend yields.
And what about bond fund managers? Do they, as a group, manage to overcome their costs any better than stock fund managers?
Generally, no. As a group, bond fund managers will inevitably deliver gross returns that just track the overall interest rate environment. A few might do better through skill or luck, or maybe by taking extra risk like buying longer-term bonds. But bad decisions often hurt returns later, thanks to reversion to the mean. Even if they add a tiny bit to gross returns, they rarely overcome the fund expenses, fees, and loads involved.
And the data on bond funds confirms this. Index funds tend to win there too.
It does, very convincingly. Over 15 years, bond indexes beat an average of 85% of all actively managed bond funds across various categories. It shows the dominance of costs applies just as much, if not more, in the bond world.
Why the difference?
The average shortfall for active bond funds was about 0.55% annually. That gap is largely explained by the expense ratio difference. Index funds cost maybe 0.10%. Active funds average around 0.75%. Costs explain the gap.
So the total bond market index fund is basically the bond world's equivalent of the S&P 500 index fund for stocks.
In many ways, yes. It tracks a broad index of investment-grade U.S. bonds, offering high-quality diversification. It consistently delivers returns very close to its index, proving the power of the low-cost, passive approach for bonds, too.
What's fascinating here is that the value proposition for bond index funds seems identical to stock index funds. Broad diversification, rock-bottom costs, discipline, tax efficiency, long-term focus. It's a universal principle.
Exactly. Peter Fisher at BlackRock saw investors wanting simpler bond portfolios so they can sleep at night. Tim Hale stated the evidence comes down firmly in favor of investing in index funds for bonds, largely due to fees. It's the same humble arithmetic, just maybe even more pronounced because bond returns are inherently more predictable based on starting yields.
Let's talk about exchange-traded funds, ETFs. They have absolutely exploded in popularity over the last couple of decades. They seem to be everywhere. Are they the new frontier of smart investing, maybe a better way to index, or do they introduce new risks?
That's a really important question, and the answer is, well, it's nuanced. There's nothing fundamentally wrong with investing in broadly diversified index ETFs that track the whole market, provided you don't trade them frequently. Long-term investment is a proven strategy. Broad market index funds, whether they're traditional mutual funds or ETFs, are great tools for that. But short-term speculation, especially using ETFs, still a loser's game.
So the key differentiator is the trading aspect, because our sources highlight some pretty stark differences between traditional index funds, TIFs, and ETFs.
That's exactly right. TIFs are designed for maximum diversification, longest horizon, lowest cost, highest tax efficiency, guaranteed market share. ETFs can offer broad diversification, like the original Spider 500 ETF, but they're often specialized, which just invites trading. And their costs are only truly low if you ignore the trading costs, commissions, bid-ask spreads.
So ETF traders don't necessarily get the market return.
No. ETF traders have absolutely no idea what relationship their investment returns will bear to the returns earned in the stock market. There's no guarantee of getting your fair share after all the selection issues, timing risks, extra costs, and potential taxes from trading.
Let's talk about the Spider SPDR S&P 500 ETF, the very first U.S. ETF back in '93. It tracks the S&P 500. Sounds like a good index fund.
Look, a brilliant idea. Low cost, tax efficient if held long term. A potential competitor to TIFs. The Spider is still the largest ETF. But here's the kicker. It's used primarily by short-term investors.
Really? How short-term?
In 2016, it traded an incredible $5.5 trillion. That's an annual turnover rate of 2,900%. The main users are banks, active managers, hedgers, traders, turning over their holdings at nearly 1,000% annually. That's pure speculation, not investing.
Wow. So even a well-designed broad market ETF is mostly used for rapid trading, and the growth of ETFs overall is just explosive.
It's a stampede. ETFs now make up half of all index fund assets. Over 2,000 ETFs exist now, way up from just a few hundred a decade ago. But look at what they are.
What do you mean?
Only about a third of ETF assets are in those broadly diversified stock index funds we like. Compare that to over 60% for TIFs. A huge chunk of ETF money, nearly a quarter, is in concentrated sector bets, speculative strategies, inverse funds, leveraged funds.
The stuff far removed from simple indexing.
Exactly. A dramatic shift away from the original principles.
And the cash flow data tells a story, too.
Oh, yeah. ETF cash flows. Exceptionally volatile. Huge inflows near market highs, massive outflows near market lows. That's counterproductive investor behavior writ large. TIFs, meanwhile, saw consistent inflows during the same rough periods. So yes, in many ways, ETFs have strayed far from buy and hold, diversification, and rock-bottom cost.
It's almost like a powerful tool being misused, like that Purdy shotgun metaphor in the book.
Precisely. A Purdy is the world's best shotgun, a brilliant tool. But it's also an excellent weapon for suicide if you misuse it. ETFs, while cleverly designed, can be wealth-depleting if investors give in to the temptation to trade constantly, to speculate.
So investors trading ETFs face that double whammy.
Exactly. Counterproductive market timing, chasing hot sectors, plus accumulating heavy commissions and fees. It encourages speculation over investment. Great for entrepreneurs creating ETFs, great for brokers, but often an investor's folly.
So the core questions for listeners are ETFs really low cost once you factor in commissions and taxes from trading? Is constantly buying and selling actually better than just buying and holding?
Don Phillips at Morningstar called it the dark side to indexing, warning the potential for harm increases as index products get more specialized. Jim Wayant, founder of ETF.com, said trying to beat the market in any way usually means you get beaten by the cost of trying. The message: use broad market ETFs for long-term holding if you like, but beware the speculative trap of constant trading.
Okay, the undeniable success of traditional indexing has sort of spawned this new breed of funds, smart beta index funds. They promise to deliver higher returns by tweaking the standard indexing formula. Are these truly a revolution, a new paradigm, or something else?
Well, traditional index funds, TIFs, have been a huge success, no doubt. And that success bred fierce competition, leading to price wars, driving expense ratios down, which is fantastic for us investors.
Right.
But that success also creates an incentive for fund promoters to innovate, maybe in ways that don't always serve investors best. They need new ways to charge higher fees.
And this new strategy is creating new indexes, often using the ETF structure, claiming they can consistently beat the broad market indexes and charging more for it.
That's the pitch. The difference is, traditional active managers claim they can pick winning stocks. These smart beta managers create their own custom indexes. They weight portfolios based on specific factors, things like value, momentum, size, dividends, instead of just market capitalization. They promise a way to get more than the market return.
So what does this really mean? It feels like the responsibility for managing investments is subtly shifting, away from active managers picking stocks and on to investors who now have to pick these new smart beta strategies.
That's my concern exactly. I confess I'm skeptical this change will truly serve investors well in the long run. These strategies often rely heavily on data mining.
Looking backwards for what worked.
Exactly. Finding factors that would have outperformed historically. But we know consistently outpacing the market is difficult, partly because of the power of reversion to the mean. Today's winning factors are all too likely to be tomorrow's losing factors.
So it's like remembrance of things past, echoing historical fads that didn't end well for investors, like the go-go funds or Nifty 50.
Precisely. These fads are great for fund sponsors launching new products, but they're almost always awful for investors who pile in late. Successful short-term marketing strategies are rarely, if ever, optimal long-term investment strategies. And while smart beta assets have ballooned, recent performance already shows reversion to the mean is alive and well. Factors flip-flop.
And the proponents of these strategies use some pretty grand language, calling themselves the new Copernicans, proclaiming a huge paradigm shift.
Oh yeah, grandiose claims abound. A revolution. But let's look at the actual record. Over a decade ending in 2016, the simple S&P 500 index fund often outpaced or performed very similarly to these smart beta strategies, especially on a risk-adjusted basis.
And they're not that different from the main index.
What's really telling is that many smart beta ETFs have a remarkably high correlation with the S&P 500. They track it very closely, essentially making them high-priced closet index funds.
So it boils down to choosing between a certain outcome and an uncertain one.
Precisely. The S&P 500 index offers the certainty that you'll earn nearly the entire return of that market index, minus tiny costs. Smart beta offers an uncertain outcome, with higher fees for that uncertainty. Is it better to be safe than sorry? My prophetic warning, echoing the book, is the greatest enemy of a good plan is the dream of a perfect plan. Stick to the good plan, the traditional index fund.
And this view is widely shared by some really respected names in finance.
Oh yes, Harvard's Gregory Mankiw. I am placing my bets with Bogle on this one. Nobel laureate William Sharpe. Smart beta is stupid. Betting against the market is indeed likely to be a hazardous undertaking. Wharton's Jeremy Siegel. Maximum diversification is achieved by holding each stock in proportion to its value. For most of us, trying to beat the market leads to disastrous results. The consensus is clear. The traditional broad market index fund remains the optimal, simplest path.
Let's shift gears slightly. Benjamin Graham, the legendary investor, author of The Intelligent Investor, Buffett's mentor. He published his masterpiece long before the first index fund even existed. But did he somehow anticipate this revolutionary idea of just owning the market?
He was remarkably prescient. Graham advised defensive investors to be satisfied with the reasonably good return obtainable from a defensive portfolio and stoutly resist the recurrent temptation to increase this return by deviating into other paths.
So it's like indexing.
Doesn't it? Even though the first index fund wasn't around until '74, Graham was, back in 1949, presciently describing the essence of that precedent-setting fund. His advice to emphasize diversification more than individual selection and stick to standard, conservative, and even unimaginative forms of investment sounds exactly like the index fund concept.
And he was pretty skeptical of Wall Street overall, wasn't he?
Deeply skeptical. Graham knew Wall Street was in business to make commissions, giving customers what they want, even if it meant trying to make money in a field where they are condemned almost by mathematical law to lose. He called the whole thing a Falstaffian joke, very critical of the conflicts.
He also had a realistic view of the active mutual fund managers of his time.
He did. Back in '49, he saw that funds mostly just matched the market, only absorbing the expense burden. Later, in '73, he criticized unsoundly managed funds that produced spectacular but largely illusionary profits for a while, followed inevitably by calamitous losses. He was talking about the go-go funds then, but it perfectly described the dot-com bubble later, too.
So his timeless message was ultimately about the power of just owning and holding for the long term.
Absolutely. Graham's core message. The real money in investment will have to be made, not out of buying and selling, but of owning and holding securities, receiving interest and dividends, and benefiting from their long-term increase in value. That philosophy is the core of indexing. Own diversified securities, hold them forever.
This all leads to the ultimate validation. Did Graham actually explicitly endorse index funds later in his life once they existed?
He did. In a 1976 interview, someone asked if the average manager could bet the S&P index. Graham's blunt answer: no. Should investors be content with market returns? Yes. He even said he saw no reason why they should be content with results inferior to those of an index fund. He even admitted that finding superior value through elaborate analysis wasn't as rewarding anymore because of all the research being done.
Wow. And that, of course, was definitively confirmed by his most famous student, Warren Buffett.
Yes. Buffett personally told Jack Bogle, a low-cost index fund is the most sensible equity investment for the great majority of investors. My mentor, Ben Graham, took this position many years ago, and everything I have seen since convinces me of its truth. Can't get a stronger endorsement than that.
Okay, with the basics of indexing firmly established, the next huge step is structuring our portfolio. This isn't easy, but Benjamin Graham thought it was the most important investment decision we make. What exactly is asset allocation, and why is it so critical?
Asset allocation is simply how you divide your investment money between different types of assets, mainly stocks and bonds. Graham thought it was paramount, and a landmark 1986 study backed him up. It found asset allocation accounted for a stunning 94% of the differences in total returns achieved by big pension funds.
94%. So how you divide between stocks and bonds matters vastly more than picking individual stocks or funds.
Far, far more impactful.
And what was Graham's standard division back in 1949? What did he recommend?
Graham suggested a basic rule: never have less than 25% or more than 75% in stocks. With the opposite for bonds, his standard starting point, a 50-50 split. But, and this is crucial, remember the context, in 1949, stock yields were much higher than bond yields. Today, those yield tables are turned upside down. Stocks yield less than bonds typically. That changes the calculation significantly.
Right. So what factors should today's investor consider when figuring out their personal asset allocation?
Two fundamental things.
Yeah.
Your ability to take risk and your willingness to take risk.
Ability versus willingness.
Right. Your ability depends on your financial situation, your assets, your future needs like retirement or college, your time horizon. More ability if liabilities are far off or you have plenty of assets. Your willingness, that's pure personal preference. Can you sleep at night with big swings? Volatility isn't the only risk. Being forced to sell in a down market is critical too. Together, these define your risk tolerance.
And how does this translate into a basic model, say, for someone young accumulating wealth versus someone older in retirement?
Generally, younger investors accumulating wealth can afford to be more aggressive, take more risk, maybe target 80% or more in stocks.
Yeah.
Older investors in retirement, needing to draw income, usually need to be more conservative, maybe only 25% stocks, prioritizing avoiding big losses over maximizing future returns. They need to avoid selling low to cover expenses.
Okay, so putting it all together, there seem to be 4 crucial decisions for your asset allocation plan.
That's a good way to sum it up. 1, strategic stock-bond mix. The big one, based on your individual needs, ability, willingness. 2, fixed versus variable ratio. Do you keep a fixed mix by rebalancing periodically or let it drift? Fixed is prudent, limits risk. 3, tactical allocation. Trying to shift your mix based on market forecasts, generally discouraged. Requires prescience, few have. 4, active versus index funds. The evidence here is overwhelming. Use low-cost index funds for both stocks and bonds.
And there's a fascinating link between risk and costs here, isn't there? You mentioned that a lower risk portfolio can actually outperform a higher risk one if the costs are right.
Absolutely. This is powerful and often missed. A low-cost portfolio with less in stocks, lower risk, can actually earn the same or even higher net return than a portfolio with more in stocks, higher risk, if the costs of the lower risk option are significantly lower.
So low costs let you take less risk for potentially the same or better outcome.
Exactly. Low costs enable lower risk portfolios to provide higher returns than higher risk portfolios. It turns conventional risk return thinking on its head.
Now, that really brings a human element to it. It's not just numbers.
It's not. There's no perfect science here.
Yeah.
Jack Bogle himself kept about 50-50 indexed stocks and bonds, even in his late 80s. He admitted half the time he worried he had too much in stocks, the other half too little. We're all just human, operating in a fog of ignorance, using our circumstances and common sense. Graham's 50-50 target, with maybe a 25-75 to 75-25 range, using simple index funds. Still a very sound starting point.
Okay, we've covered the general principles of asset allocation. Now let's zoom in on retirement investing specifically, and those convenient funds that kind of set the allocation for you, like target date funds. What's the story there?
Right. Back in the early 90s, the idea emerged that a simple mainstream balanced index fund, say 60% U.S. stocks, 40% U.S. bonds, could act as a complete investment solution. Diversified, low cost.
And Vanguard launched one based on that.
Yes, and that 60-40 balanced index fund has been a phenomenal success.
How so? What's the track record like?
Over 25 years, it earned a return significantly higher than its actively managed peers, about 1.7 percentage points per year higher. Why? Mostly due to its tiny expense ratio versus the much higher average for similar active funds. Plus, it offered great protection in downturns. For investors wary of volatility or with shorter timelines, this set-it-and-forget-it strategy is very appealing.
You're often cited for that rule of thumb. Your bond position should equal your age. How does that fit with these strategies, especially for retirement?
Ah, yes, the age rule. It was always meant as a flexible guideline, a starting point for thinking, not a rigid command.
Okay.
The idea is simple. Younger investors, less capital, more time, higher risk tolerance, own more stocks. As we age, accumulate assets, become more risk-averse, rely more on income, shift toward more bonds. But it needs flexibility. Constantly selling stocks just to hit an age target could trigger huge capital gains taxes, for example.
And for retirees, the focus really shifts, doesn't it? Away from just the market value of the capital towards generating a steady income stream.
It's exactly. In retirement, the most important thing is often a steady, inflation-adjusted income to live on. Think Social Security, fund dividends. Worrying about the daily market value of your portfolio can be counterproductive. The goal is reliable, consistent income.
There's also this relatively new three-fund model for asset allocation that's gaining traction.
Yes, many advisors now suggest a simple three-way split. Maybe 33% bond index, 33% U.S. stock index, 33% international stock index. Reflects a broader acceptance of global diversification.
But Bogle himself was historically cautious on international stocks for U.S. investors.
He was. He's citing currency risk, the already global nature of big U.S. companies' revenues, the strength of the U.S. economy. His advice back in '93 to largely avoid non-U.S. stocks worked out well, as he put it. It's a point of ongoing debate.
Many fund families offer preset allocation funds, too, like Vanguard's Life Strategy or Target Retirement Funds. How should people approach those?
Life strategy funds offer fixed allocations. Growth is 80% equity, income 20%, etc. Target retirement funds automatically adjust, following a glide path, becoming more conservative as in your retirement.
Convenient?
Very convenient. They can be excellent choices, especially for beginners or those who want a hands-off approach. But, crucial point, you have to look under the hood, compare their costs. Index-based target date funds, TDFs, have very low average costs, maybe 0.13%. Actively managed TDFs, average costs are much higher, maybe 0.70%. The low-cost index-based TDFs are likely your best bet.
And it's also vital not to forget Social Security when figuring out your real asset allocation, right?
Absolutely critical. Social Security is a major income source for most retirees. You should think of its value as a bond-like asset in your overall portfolio.
How does that change things?
Well, say someone has a $1 million portfolio, split 50-50 stocks bonds. If their Social Security benefit has a capitalized value of, say, $200,000, their effective allocation is actually more conservative than 50-50, maybe closer to 42% stocks, 58% bonds. Target date funds often ignore this, potentially making investors too conservative.
Interesting. And finally, what about withdrawal rates in retirement? How much can you safely take out?
The classic rule of thumb is the 4% rule. Withdraw 4% of your portfolio annually, income plus capital, adjusted for inflation. But flexibility is really key. Markets down. Maybe withdraw less that year. Markets soaring. Maybe reinvest some surplus. That flexibility helps your portfolio last through the ups and downs.
This simple index-based approach to allocation really seems to prove itself when tested against more complex strategies.
It really does. Ben Carlson, who writes A Wealth of Common Sense, analyzed what he called the Bogle model. Basically 40% U.S. stocks, 20% international stocks, 40% U.S. bonds, all indexed. He showed it consistently beat the average and even the top-performing university endowments over 3, 5, and 10 years.
Wow, beat the endowments.
Yeah. His conclusion: simple versus complex, operationally efficient versus inefficient. The simple, efficient Bogle model wins because investing is hard enough as it is before introducing a complex, inefficient, low-probability investment style. Couldn't say it better myself.
Okay, to wrap up our deep dive, let's try to distill all this wisdom into some truly timeless truths. Maybe channeling someone known for practical common sense, like Benjamin Franklin.
I remain absolutely confident in this. The vast majority of families would be incredibly well served by simply owning broad market index funds for their stocks and bonds. Maybe low-cost municipal bond index funds if they're in high tax brackets.
Is it the absolute best strategy ever?
Maybe not theoretically the best ever devised.
Yeah.
But the number of investment strategies that are worse, it's infinite.
And Warren Buffett keeps reinforcing this simple message.
He does, unequivocally. Most investors will find that the best way to own common stocks is through an index fund that charges minimal fees. Those following this path are sure to beat the net results of the great majority of investment professionals. And that applies to bonds, too.
So despite all the uncertainty in investing, what are the common sense realities that we really do know for sure?
Okay, what we know. Start early. Invest regularly. Investing has risk, but not investing guarantees financial failure. Know where returns come from, stocks, bonds.
Yeah.
Eliminate individual security, manager, and style risk with total diversification via index funds. Only market risk remains. Minimize costs, they matter overwhelmingly. Minimize taxes. Know that beating or timing the market consistently is impossible for most. Acknowledge what we don't know, future events, but prepare with intelligent allocation.
And the goal?
The goal is simple. Earn your fair share of the returns that businesses generate, and the traditional index fund is the only investment that guarantees the achievement of that goal.
It's incredible how many of these core principles echo the maxims of Benjamin Franklin from centuries ago.
Truly remarkable parallels.
Franklin said, an investment in knowledge always pays the best interest. For us, that priceless knowledge is about risks and costs. On markets, Franklin advised, one man may be more cunning than another, but not more cunning than everybody else. Don't think you can outsmart the entire market.
Great estates may venture more, but little boats should keep near shore. Diversify. Be cautious if you have modest means.
Good advice.
On forecasting. 'Tis easy to see, hard to foresee. Acknowledge what we don't know about the future.
If you would have a faithful servant, serve yourself. Don't ignore your own economic interests by paying high fees. And on steadfastness, industry, perseverance, and frugality make fortune yield. Stick to your plan, think long-term, stay the course.
These parallels just show that the principles of sensible saving and investing are truly time-tested, maybe even eternal.
The way to wealth, I'll say it one last time, isn't just capitalizing on the magic of compounding returns, it's also avoiding the tyranny of compounding costs. Wall Street shouts, do something! But Main Street's interest is served by the opposite. Don't do something, just stand there. As Dr. Paul Samuelson famously quipped, Bogle's creation of the first index fund was like inventing the wheel, the alphabet, and wine and cheese, essentials that stand the test of time. And so will the traditional index fund. Hashtag outro dels.
Wow, okay. We have navigated the complexities of costs, the illusions of active management, the powerful force of reversion to the mean, and ultimately, the timeless wisdom of just owning the market at the lowest possible cost. This deep dive hopefully leaves you with a clearer understanding of how to put your own financial interests first.
It really is about grasping those fundamental truths, isn't it? And not getting swept away by all the noise and the hype.
So what does this all mean for you, the listener? Consider the profound, maybe even radical power of doing nothing. In a world that's constantly pushing you to do something with your money, to chase the next big thing. Perhaps the most intelligent, the most courageous act is simply to just stand there, to stay the course with a simple, diversified, low-cost index fund portfolio. What familiar assumptions might you need to challenge to really embrace this common-sense approach in your own financial life?
It definitely invites a rethink of what active really means and what value truly represents over the long haul.
Indeed. Join us next time for another deep dive into the knowledge you need to be truly well-informed.